Hello guys, good day. Welcome to another video lecture in ACC 325, Governance, Business Ethics, Risk Management, and Internal Control. In this particular video lecture, we will be discussing a new topic, particularly concerning on risk management. All right. So this particular big picture of risk management will be divided into several discussions. But in this video lecture, we will focus our discussion with the concept of risk first. So we would try to explain what is the definition and the concept of risk and identify what are the different classification of risk. All right. So to start with our discussion, let us explain the concept of risk. So as we all know, company is always prone to internal and external factors whether the company will achieve or realize its objectives. The corporation might face different uncertainties, different uncertain events or conditions, and this uncertainty is what we call risk. This risk is the probability that some future event could adversely impact the organization. And this risk is measured in terms of probability and impact. All right? Risk is exposure to the possibility of loss, injury, or other adverse or unwelcome circumstance, or a chance or situation involving such a possibility. So, as we all know, when we talk about risk, when we hear the word risk, it would give us a connotation that it is unfavorable on the part of the entity or unfavorable on the part of the investor. But to make things clear, this risk is not always on the side of unfavorable. Risk may be favorable or unfavorable. All right? So risk is the exposure to the possibility of loss or injury or other adverse or unwelcome circumstance. Or in short, risk is a factor that makes you not able to achieve the organization's objective or goal. All right? So when you do business, your motive is to create profit, and always when you do business there is a risk that you would not be able to create profit or you would not be able to achieve what you want. All right? Or risk can also be a chance or situation that is reciprocal to that possibility of loss. All right? It could also be a chance that could give you a possibility of happening such goal. All right? Risk, guys, is inherent in every business. As we all know, risk is always present. Organization and entrepreneurship need to be willing to take risk, as without risk, there can be no meaningful gain. It is very common in financial management where risk is always accompanied by a return. The higher the risk, the higher the return. Like stress, one has to live with a risk and it cannot be avoided. At best, risk can be managed or mitigated. Although risk is always present, always inevitable, no? But what is good is that this risk can be managed or can be mitigated. Although risk cannot be eliminated, that is for sure because risk is always present, but risk can be managed or mitigated in order that the effects of this unfavorable effect of risk will not bring danger to the investors or will not bring danger to the entire organization. Okay? So again, like let me make it clear that the result of a risk is not always negative. There could always be a two sides of a coin. A risk might bring you in a positive side, and it could actually bring you also into the negative side. All right. So that is the entire concept of risk. This time, let us um, classify risk. No, there are two classification of risk in terms of um, the scope of this risk. So in terms of scope of the risk, we have this so-called systematic risk and your unsystematic risk. So let us identify what is this systematic risk first. So systematic risk is a risk factor that affects the entire market. That means it is a macro perspective, no? It affects the entire industry or the entire um, market, whether it is an effect of investment policy changes, foreign investment policy, change in taxation, or global security threats. All right? These systematic risks are beyond the control of the investors or beyond the control of every corporation and thus cannot be mitigated to a large extent. All right. So what are the specific features of this systematic risk? So we have first, it is not fully uncontrollable by an organization. Since what I have mentioned earlier that this systematic risk affects the entire industry. So therefore, it cannot be solved by a particular organization alone. All right? Because what is being affecting a particular organization is also affecting the entire organization in the market. All right? It is not entirely predictable. It is not predictable because it is an external factor, no, that the corporation has no reach at all. For example, changes in taxation. All right? So changes in taxation that could bring um, higher tax liabilities for a particular corporation. Okay? And that is not actually beyond the control of, that's not actually, or that is actually beyond the control of a corporation because that's the perspective of the government. That's on the government's um, reach on changing that taxation policy. All right? Also, in under systematic risk, it usually affects a large number of organizations operating under a similar stream. All right. For example, um, one line of industry, let us say in the cotton industry or in the petroleum industry. So, for example, there is a change in foreign investment policy in terms of importing or exporting of petroleum products that could affect not just a single organization but the entire organization operating in that industry. All right, and it cannot be fully assessed and anticipated in advance, no, in terms of timing and gravity. No one could foresee this risk, no, when will it come or when it the possibility of um facing this type of problems or facing this type of uncertainties or risk or the level of gravity. No one could predict or assess the level and the extent of the possible effect of this systematic risk. And lastly, systematic risk is usually concerned with interest rate risk. All right. When we talk about interest rate risk, it's a type of risk where it involves the possible fluctuation of interest rate. And that alone, guys, an entity has no reach, has no control because it is on the third party's control on what is the interest in the market. It is the market who will identify that interest rate risk. Another is market risk or the purchasing power. So in total, no, in to sum up the concept of this systematic risk, these are really the types of risk that number one affects all organization in an industry and at the same time um, cannot be solved by a particular organization alone. All right. So this is your systematic risk. On the other hand, we also have this so-called unsystematic risk. So it is the reciprocal concept of systematic risk. So systematic, we also have unsystematic. So it is the exact opposite of your systematic risk. So when we account systematic risk in a macro perspective, unsystematic risk also penetrates in a micro level. That means it affects single firm alone. When systematic risk affects all organization in a certain industry, this unsystematic risk only penetrates a single organization or a single firm. Right? Thus, this risk is controllable by an organization. Since it only affects one single organization, therefore that organization also, that sole organization can also control such particular risk. And it is predictable, unlike with systematic risk. And at the same time, as what I have said, it is on the micro level in nature. It if not managed, it directly affects the individual organization first because obviously it only affects a particular firm, and it can be usually assessed well in advance with reasonable efforts, and risk mitigation can be planned with proper understanding and risk assessment techniques. So example of unsystematic risk are compliance risk, credit risk, or operational risk. So talking about, let's say, compliance risk. Compliance risk is obviously um, affects, for example, a particular firm. If an entity would not comply a particular regulatory provision, then obviously there are adverse effects it could bring to the entity. So how would the entity manage or control this compliance risk? All right, since it is the organization itself who could just save from this type of risk, then therefore they could also be the one who could create no activities or strategies that could mitigate this compliance risk. So for example, in order for them to make sure that they are complying with every regulation which they are under, they must, for example, um, elect or appoint a compliance officer that will make sure and oversee that all provisions of all government regulatory agencies where this corporation is under are really complied. In that sense, they could actually mitigate or manage the possible effect of their compliance risk. So that is systematic versus unsystematic risk. Another of classification of risk, guys, is your financial and non-financial risk. So from the term itself, financial and non-financial, we could easily distinguish these two based on or in terms of money, all right, or in terms of finances. So under financial risk, these are risks which has come direct financial impact on the entity. All right. So as long as it has something to do with finances or in money or sources of funds for a particular organization, then that can be considered as a financial risk. This risk may be market risk, credit risk, liquidity, operational risk, legal risk, or country risk. Okay? The following depicts some of the various types of the financial risk. So this chart, guys, is referring to the different types of risk that we will be discussing one by one later on. But again, to sum up the concept about financial risk, if this risk has something to do with the finances of an entity, then it can be identified as part of the financial risk. All right. On the other hand, the exact reciprocal concept of financial risk is your non-financial risk. So this type of risk do not usually have direct and immediate financial impact on the business. But the consequences are very serious and later do have significant financial impact if these risks are not controlled at the initial stage. So although this non-financial risk indirectly affects or not directly affecting the finances of an entity, but if this non-financial risk not taken good care at hand or at initial on its initial stage, if it is not mitigated, if it's not striked on the initial stage, then it can actually affect eventually your finances, or it could become um provoking factors ng inyong financial risk. This type of risk may include business or industry and service risk, strategic risk, compliance risk, industry fraud risk, reputation risk, transaction risk, or disaster risk. All right. So these are two financial and non-financial risks. So this time, let us discuss one by one these types of risk, no, both financial and non-financial risk. So let's talk about financial risks first. So we have here the first risk under financial risk, which is your market risk. So if you could imagine how many risk, how many word of risk we are, uttering in this lecture. So this type of risk, talking about market risk, is associated with market ups and downs. It refers to the risk of losing arising from the change or volatility in the market prices or economic values, which are the deciding factors for the pricing of a product or financial assets. Okay? So that means market risk are those factors that could affect your risk. Okay? That could affect the price. No, that could affect the price of your goods or services offered in the market. So whatever made that factor, whatever is that internal or external factor, if it has something to do with dictating the price of a market, of a market's goods or services, then it could be considered as a market risk. Under market risk, it is stratified into specific types of risk further, like interest rate risk. So, interest rate risk, as mentioned earlier, is also considered as a systematic risk. All right. So, interest rate risk, the financial assets which are connected with interest factors such as bonds, debentures, faces the interest rate factor or the interest rate risk. For example, interest rate risk adversely affects the value of fixed income securities. So any increase in the interest reduces the price of bonds and debts, instruments and debt or market or vice versa. So for example, interest rate greatly affects for, let us say, those issuers of bonds or those investors of bonds. Okay, so let us have on the perspective for those the issuers of bonds or bond certificates. So obviously, when you are an issuer of your bonds, obviously you are a debtor. You are the ones who is requiring finances. So that is why you issued bonds. No? So the nature of bonds usually pays an interest on a per annum basis. All right. And now, obviously, if your interest rate goes higher, all right, if that interest rate go higher, there's actually a risk of you to incur more interest expense every year as this interest rate increases. Okay? So, that means you would be on the disadvantage if your interest rate goes up, all right? Pero that would also be the reciprocal concept when you are the investor. Because if you are the investor, you will be the ones who accounting for your interest income. All right? And then the more the interest rate goes higher, the more also that your interest income will go higher. All right. So that is why, as what I have mentioned earlier, that risk is not always unfavorable. Okay. It can be favorable at one point and it could be unfavorable at one point. All right. So that is interest rate risk. No, the risk of possible fluctuation of your interest rate. Okay. Now, at this point of discussion, our objective is just simply to introduce and to discuss what is this risk all about. Later on in our second part of discussion, we would like to have the steps on how are we going to mitigate these risks. Okay? So that will be discussed later on. But again, let us continue on discussing what are these risks, no, that the entity might be facing. The second in the list, particularly in market risk, are your currency risk. So it is the volatility in the currency rates. All right. These risks affects the firms which have international operations of business, and the quantum of the risk depends on the nature and extent of transactions with the external market. from the word itself, currency risk. So it is depending on the value of your currency. As we all know, since you have discussed it in your advanced accounting, in your foreign currency transactions, your currency, no, your currency valuation is not absolute. It might change. It might fluctuate from one point or to another point of time. So that means that could also affect your proceeds or your inflows or outflows depending on who are you, no. For example, you are an importer or you are an exporter. For example, if you are an importer, so that means you are buying goods from outside the country, so that means you are accounting for your accounts payable. All right, so if your currency risk increases, all right. All right. If your currency or the value of your currency, no, where that transaction is denominated would increase, that would be your disadvantage because that means higher accounts payable on your part. Pero on the other hand, when the currency of that denominated transaction goes lower, all right, that could also be your advantage since there will be lesser payable that will be settled. Alright, so that is currency risk. The risk of possible paying higher amount of money because of a particular transaction that is denominated with a foreign currency. And that currency risk also is a systematic risk. No? It does not only affect a single firm, but it affects all other importers or exporters. Another types of market risk is your equity risk and commodity risk. So talking about equity risk, it means the depreciation in one's investment due to the change in market index. So for example, in the context of securities, beta of a stock tells us the market risk of the stock and it is associated with the day-to-day fluctuations in the market. So equity risk, it has something to do with the value of your portfolio. So as we all know, the values of your shares depends or reacts on how, no, the market works. So that means there's a tendency that your shares or your portfolio of shares or your portfolio of investment might lose its value or might increase its value. So that is equity risk. Another last classification of risk under market risk is your commodity risk. Commodity risk, this is a type of risk that is associated with the absolute changes in the price of commodity. No, it's the changes in the price of the goods or services. Since commodities are physical assets, hence the price change on account of the demand and the supply factor. All right, commodity risk, it's the risk of losing its value or appreciating its value depending on the demand and supply um, factors or demand and supply na equation in the market for your good offered in the market. So that is market risk. So again, market risks are those factors or risks that has something to do with um, earning of income in the market. Okay? So another type of financial risk is your credit risk. Alright, so si credit risk naman, from the word itself, credit, so utang, no? It has risk your utang. Pag magpautang, you will really engage yourself to so much risk. So it's when a counterparty is unable or unwilling to fulfill their contractual obligation. That time, your credit risk arises. So this type of risk is related to the probability of default and recovery date. So its effect is measured by the cost of replacing cash flow if other party defaults. For example, in case of loan given by a bank to the borrower and the borrower defaults in making payments of the installments or due interest on due date, then it is termed as a credit risk. I think that the concept is very um self-sufficient, no? Credit risk arises when there's a possibility that your debtor will default. And that will always be present, no? If you engage yourself into credit transactions. There could really be at some point that there is a possibility that your debtor, no, will be on default or your debtor will not be able to would breach no your creditor debtor agreement. Okay, so that is credit risk. Also later on we will be discussing what are the possible actions that an entity could do in order for them to mitigate this credit risk. All right. Another is liquidity risk. So si liquidity risk naman is from the word itself, liquidity. Liquidity risk arises due to mismatches in the cash flow, like the absence of adequate funds. Liquidity is altogether different from word solvency. A firm may be in sound position as per the balance sheet, but the current assets are not in the form of cash or near cash assets. So the firm may not make payment to the creditors, which adversely affect the reputation of the firm. As we all know, guys, the definition and the concept of liquidity has something to do with the settlement of short-term maturing obligation. And that short-term maturing obligation includes, example, your obligation towards your employees, your obligation towards your suppliers, and all other liabilities that is required to be settled at time. Okay? So liquidity risk is the risk where you would have nothing to pay these obligations. You don't have enough assets. Although you can be solvent, but at times you can be unliquid. So that means you don't have enough cash or near cash assets or those cash equivalents that can be used in settling these liabilities. So that's when your liquidity risk, right? Another, guys, actually your liquidity risk is also stratified into a further classification of risk. We have trading risk and funding risk. So when we talk about trading risk, it may mean the absence of the liquidity or enough products or securities or etc. to actually undertake buy and sell activities. So in the context of security trading, and ability to enter into derivative transactions with counterparties or make sales or purchase of securities is what we call your trading risk. Okay, trading risk is you don't have something to trade, in short, no? You have out of something to trade. While funding risk, it refers to inability to meet the obligation, no? Yung na-mention nato kanina na major concept of your liquidity risk. It's the inability to manage funds by either borrowing or the sale of assets, securities. It arises where the balance sheet of firm contains illiquid. What do we mean illiquid? That means the total assets is more on inventories, it's more on property, plant, and equipment, intangible assets, and all other not so liquid assets. Okay? Or, yeah, illiquid financial assets, or in short, majority of your assets are non-current. No? That can somehow affect your liquidity risk and eventually your funding risk, particularly if you don't have enough um, near to cash na mga types of assets. All right, so let's go back with the types of financial risk. So this time we'll have obsolescence risk or obsolescence risk. So from the word itself, obsolete, no, it has something to do with your inventories. In the rapid changing world, obsolescence is fast emerging, and unless the companies are able to cope up with this timely, the impact will be quite heavy and may lead to closure of the units, like Nokia. So Nokia was not able to adopt with the changes, all right, in terms of the technology it incorporates to smartphones and all other products that it has offered in the market. No, it is not quick enough to adapt the change on what is happening in the industry. All right, so that makes their product, no, offered in the market obsolete. All right. And as we all know, customers in their nature, they will always go up to trend. All right. So that could be obsolescence risk. The risk of making your inventories become obsolete. Okay. Another, guys, is your legal risk. So from the word itself, legal naman. So this risk arises when a counterparty does not have the legal or regulatory authority to engage in the transactions. It also include the compliance and regulatory risk like insider trading, market manipulations, defaults, and mismanagement of legal affairs. So, um, it for example, you are entering into a contract, but the other party is incapable into entering a contract. So that could be a possible legal risk, no? Or maybe um, based on whatever reason may that be, no? So could be the reason of that legal risk as long as they were not able to follow a particular regulatory provision or um, a law that's mandated by a regulatory agency, no? That's in short, they how would I know this? They have downfall in terms of the legality in order for them to become a valid partner in a contract. So that is a legal risk. Okay. Another type of financial risk is your political country risk. Yes, it is considered as a financial risk. Political risk may be on account of declaration of elections in the territory, area specific risk, and political uncertainty. So the country risk arises where the firm have its business operations abroad. So these risks may arise due to outbreak of war between countries, imposition of the ban on the business transaction of a particular commodity or product. Okay? So, political country risk is really somehow would really um break the finances of an entity because a product of a particular country might be banned on a particular country due to political reasons. This can also be existing risk due to a country's legal or political structure which drives other institutions like judiciary, legislative, and general environment for business. Or in short, a particular country due to its political reason or whatever reason they may have, they could not allow your products to be sold in this country or in these places. So that is political country risk. All right. So those are the different types of financial risk. Okay. So again, in summary, your financial risk has something to do with financial. No, it affects the financial capability, financial extraction capability of an entity. Okay. So this time proceed tayo kay non-financial risk. So si non-financial risk, we have identified earlier na it has indirect effect. It has no direct effect with your finances. Pero when it is not taken good care, if it's not mitigated initially, it could really affect and could contribute and become a financial risk. Okay? So example tayo, number one is business industry or service risk. So when we talk about business industry or service risk, business risk implies uncertainty in profits or danger of loss and the events that could pose a risk due to some unforeseen events in future which causes business to fail. Business risk refers to the possibility of inadequate profits or even losses due to uncertainties. Example are changes in tastes of your customer, preferences of the consumers, strikes of your employees, increased competition, change in government policy, or obsolescence. Okay, obsolescence, as we all know, we have identified it earlier as a financial risk. But let's proceed, for example, in strike, all right, or increase in competition. So what if you have more competitors? Okay, that could have a very blatant effect on your business because when there is increased competition, that means that the supply would be increased as well because there will be more entities that will offer the same product and services that you are also offering. So that means there is a possibility that your customers will now go on that new industry or a new firm in the industry. All right. So that means that if you would not be able to mitigate that increased competition, if you would not able to take good care of your customers, then that could lead to a financial risk. Although this time it could be an industry or service risk, but later on it will really affect the finances and become a financial risk. Because what will happen if you don't have if you have more competition? That means there's a possibility that they will magnet your customers. And if that will happen, that will reduce your revenue and thus becomes a financial risk. Okay. Another type of non-financial risk is your strategic risk. So talking about strategic risk, these are business plans which have not been developed properly and comprehensively since inception may lead to a strategic risk. Okay. Mm-hmm. It's a um, it's a plan. It's a plan that's that's improperly planned. Okay, because a business plan is a plan in the first place, but um, it was not perfected with utmost consideration. That is why it was implemented, no, nga hilaw. It's not yet hinog in short. Kay hilaw pa man, it's not yet hinog. So napugos siya o implement even if it's not yet tested to be productive. Okay? So example, strategic risk might arise from making poor business decisions or from substandard execution of decisions or from inadequate resource allocation or from failure to respond well to changes in the business environment. So strategic risk, okay, so strategic risk guys a is an example of an unsystematic risk. Unsystematic risk because it is controllable by a particular entity. It only penetrates a particular firm. So it's a problem of a firm. So it can also be solved by that particular firm as well. Okay? So that is strategic risk. Or in short, from the word itself, strategy, you were not able to apply that strategy properly. Okay? Strategy was properly crafted, but it was not properly implemented. Okay? Iba ang words, iba ang actions. Okay? So you should, you know, reciprocate your strategic decisions into actions. Strategic decisions into strategic actions. Another is compliance risk. As mentioned earlier, compliance risk is also a non-financial and as well it's classified as a unsystematic risk. So this risk arises on account of non-compliance or breaches of laws, regulations, which the entity is supposed to adhere. It may result in the deterioration of reputation in public eye, penalty, and penal provisions. Okay? So if you did not comply something that is required to be complied, then obviously you will be punished or it might actually break your license to operate. Or in short, or other example of compliance risk, if you breach a particular contract with another party, you did not comply with the 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 covenant, for example, that could actually penalize you for an interest or possible payment at or payment on demand of a particular liability. So that's compliance risk. Another type of non-financial risk is fraud risk. So speaking of fraud, no? Fraud and error is different. Fraud is there is an intention, no? There is an intention to defraud a particular party. So fraud is perpetrated through the abuse of systems, controls, procedures, and working practices. So it may be perpetrated by an outsider or insider. Yes, there could be a collusion, no, between insider or between employees or even between key management personnel to defraud other parties involved. Fraud may not be usually detected immediately, and thus the detection should be planned for on a proactive basis rather than on a reactive basis. So fraud, um, obviously the best way to mitigate your fraud risk is to maintain um, regular implementation and assessment of your internal control because no one will defraud, no? No one will try to defraud someone if no one would agree that they can be defraud. All right? So that's fraud risk. Another is reputation risk. So this type of risk arises from the negative public opinion. Such type of risk may arise from the failure to assess and control compliance risk and result in harm to existing or potential business relationships. Okay, so reputation risk that has something to do with your image, no, that will bring down the goodwill of an entity. Okay, for example, possible degradation of the environment. No, your activities did not actually help, but in fact destroys the environment. That could actually break your reputation. Okay? And may somehow eventually become a reason nga finances will go in sa entity. Another is transaction risk, guys. So transaction risk, it arises due to the failure or inadequacy of internal system, information channels, employees, integrity, or operating process. Okay? So transaction risk meaning, if I have understood it correctly, transaction risk is not able to follow the process. Okay? So there is breach of process, no? There is possible bypass of authority. Okay, due to, for example, inadequacy of internal system, like duties of inadequate separation of duties, for example, um, or the likes na mga instances. Another risk, guys, is your disaster risk. So, disaster risk on account of natural calamities like flood, fire, earthquake, man-made risk due to extensive exploitation of land or for mines activities, land escalation, risk of failure of disaster management plans formulated by the company. Okay, so disaster risk. So, as we all know, these are acts of God and it is inevitable as well. So, there could be a chances na masunog, naisunog na mahitabo, alright? Nai-flood na mahitabo, or naay-giyera mahitabo, or man-made na mga phenomenon that will somehow affect the entity's operation. Pero, although that is already inevitable na mga acts of God or mga fortuitous event, but the management did not do something, okay? Did not formulate something in order to be prepared for that happen or for that activity, for that phenomenon to happen. For example, bagyo, okay? Um, let's say your warehouse is prone to flood. Okay, if you have known that your um, area is prone to flood, then what should you do in order for your inventories and other assets to be secured? Okay, disaster risk happen when the management fails to have contingent plans to mitigate these activities or these mga phenomenon. Another, guys, is regulatory risk. So on account of change in government policies and perceptions, especially this type of risk is associated with food and beverages, and at the same time with pharmaceutical industry. So it has something to do with government policies and perceptions. I think it is the same with your compliance risk, but this time regulatory is compliance meaning um, compliant to the agreement between private entity or government entity. But regulatory risk, it has something to do solely on regulations that's implemented by the government. And lastly is your technology risk. See, technology risk, it's a failure of system caused due to tampering of data access to critical information, non-availability of data, and lack of control. So as we all know, technology is supposed to bring advantage to an entity. But if an entity has no proper control of this technology, then it could actually bring danger or could destroy the entity. All right, because there could be possible leak of important information of an entity. So in terms of technology, or in short, if you don't have um, incorporated technology at all with your entity, okay, the non availability of technology sa atuang entity. Okay? So those are your samples ng non-financial risk. So again, on our first na topic about risk management, we have explained the concept of risk and identified what are the differences or what are the different classification of risk. Okay? We have a lot of risk, and therefore as we all know, it's not really easy to run a particular business because you need to face all this risk. Okay? So our next topic guys will be risk management process. And at this time, I'd like you to search what are the risk management process? What are the basic steps that you need to do in order for you to mitigate this risk? May it be systematic or unsystematic risk, or financial or non-financial risk. I'd like you to comment it down below. What are the steps in order for an entity to manage a particular risk, or in short, the risk management process? Okay, so that will be our subject matter in our next discussion. Okay, so again, if you have more time, you can actually browse these references for more information. Okay, so if you have questions, violent reactions, or additional inputs, please reserve it and brought it during our virtual class. Okay, so that's it for our video lecture discussing the basic concepts of risk. Thank you very much and God bless.